Minister Godongwana, thank you very much indeed. It would be of some concern about you not getting the difference between 1 hour and 10 minutes, especially coming from the Finance Minister, but it's fine. We forgive you. I attended the non-aligned summit meeting in Cuba many years ago, and I remember a representative from the Cuban government giving a very short speech to delegates. It was only 3.5 hours. So, Minister, you were absolutely fine. Daniela, where are you sitting? If I could ask you to come up, and I'll make the introduction as you're getting your panel members up. Folks, that's our opening keynote speech from the Minister of Finance. Minister, thank you very much indeed, and I think all of us in this room look forward with a great deal of anticipation to the medium-term budget framework, which will be delivered in the next couple of weeks. Ladies and gentlemen, making her way to the stage is Daniela Klingerbill, who is Manager, Reserve Advisory and Management Partnership. We'll just call it RAMP for the next 2 days at the World Bank Treasury. And she will be facilitating the first of several high-level panel discussions that we're going to have over the next day and a half here in Cape Town. And the topic of this panel discussion, the outlook for the global economy and financial markets in the COVID-19 and post-COVID-19 era. That is a broad, important topic, Daniela, that you're going to cover. A very warm welcome. If I can just tell you, I know your guests do have some presentations. The little remote is next to you on your left, and I will leave it to you to call up your panel members and to introduce them. Thank you very much indeed.
Thank you. Thank you so much. Good morning. It is truly wonderful to be back in Georgetown, in Cape Town. Sorry, that's what jet lag does to you. Let me try again. It is truly wonderful to be back in Cape Town at our joint thought leadership event. And it's also very much an honor to moderate this critical panel on the outlook for the global economy and financial markets against the background of COVID-19 and the war in Ukraine. Now, let me take you back a little bit in time and set the stage. I think we've heard many of the themes and challenges that the global economy faces this morning already. In 2021, global growth strongly recovered, recording a 5.7% increase after the severe contraction of global growth in 2020 due to the outbreak of the COVID-19 pandemic. Global growth also recovered due to unprecedented efforts of monetary and fiscal authority in many countries to soften the adverse effects of restrictions that government placed on economic activities and travel to save lives. And 2020 also saw the successful rollout of effective vaccination developed at record speed, an impressive achievement after the disease had claimed more than 5 million lives worldwide. At the beginning of the year, the world economy therefore appeared to be poised to turn the page on COVID-19, and global economic growth was projected to further recover. At the same time, there were clear concerns about supply chain bottlenecks and discussions on whether observed rapid increases in inflation were only of a temporary nature. But the overall economic outlook was relatively bright. Now, more than 9 months into 2022, the global economic and financial market outlook seems significantly more gloomy and much more complex. The COVID-19 pandemic might have lost traction, but it has yet to fully disappear and continues to impact the global economy. Geopolitical tensions worldwide have surged following the Russian invasion of Ukraine. In April, increasing commodity and food prices significantly with a severe knock-on effect on inflation, business, and consumer. So in the interest of time, let me just summarize. 2022 may be the year when COVID-19 started losing relevance, or we have learned to live with the virus. But as we will hear from our expert panel speakers, plenty of challenges lie ahead. And investors have witnessed this directly, as both global fixed income and equity markets have seen sharp drops during the year, leaving investors very few places to hide. Now, our expert panelists will help us understand in greater detail what is the outlook for global growth in both developed and emerging markets, given the current state of affairs. And let's clarify, emerging markets is a really quite a different set of countries, and I'm certain our panelists will help us understand which emerging markets are particularly affected by the events mentioned. What's the specific outlook for African economies, and what major economic risks do they face? Have higher inflation expectations become entrenched? Therese mentioned the recent print in the US that led to a significant sell-off as market participants realized that despite their wishes, US inflation does not appear to be dropping off quickly. And what will be the knock-on effect of rising interest rates beyond debtors and asset prices globally? Importantly, for emerging markets, what are the spillover effects of rising global interest rates and the strengthening of the US dollars? And how much is already priced in asset market? And what is the outlook for global equities, bonds, and currencies? Finally, we've heard a number of the challenges and recommendation as to how global pension funds should continue to thrive or could continue to thrive in this challenging environment. But what challenges do pension funds and policymakers face in emerging markets in the current economic and market environment? So we're very fortunate today to have a distinguished panel of speakers with us that will answer all of these questions. Allow me to introduce the speakers in alphabetical order with only their affiliation. You have all of the backgrounds in your material. So we have Sonia Keller. Can I request that you move up to the podium? She is JP Morgan's chief economist for South Africa, followed by Patrick Kirby, who is a senior economist at the World Bank Prospects Group that is responsible for the economic projections that the World Bank uses. Olana Makubela, he's the divisional chief executive of the Retirement Fund Supervision Financial Services Conduct Authority, South Africa. And last but not least, Ezekiel Chidioko, who is the head of private sector investment operation at the African Development Bank. Can I just encourage you to come up to this stage? And let me set the ground rule. Each speaker will have at most 15 minutes. Then I will be quite aggressive in cutting them off to present. We will then have ample time for a question and answer session. And truly allow me to encourage you to make use of our expert panel and to ask questions. Now, without further ado, let me ask Patrick to present the World Bank's outlook on growth for developed and emerging market economies. Patrick, the floor is yours. And I think you have the, great.
Good morning. It's a pleasure to be here today, even if it is to deliver a fairly gloomy message. Many of the topics I'm going to cover I've already mentioned by the previous speakers, so my value added is going to come from my slides. So today I'm going to try and answer the following three questions. What are the prospects for global growth and inflation? What are the drivers of these developments? And what do these developments mean for emerging markets primarily? I'll give you a quick preview. The short answer is global growth prospects are quite bad. The main thing driving this economic weakness is the combination of high inflation and rising interest rates, and this spells trouble for emerging markets, especially those with substantial refinancing needs. Let's dig into each of these topics in more detail. The left chart shows how consensus forecasts for growth have plummeted since the beginning of the year. Over the last 9 months, forecasts for global growth have been downgraded by about a full percentage point for both this year and the next. You can see here that the downgrades are broad-based, worsening prospects for both advanced economies and emerging economies. The World Bank's latest forecasts were released in June, and I don't think I'm giving anything away if I tell you that our next published forecasts in January will also be substantially downgraded. It's not necessarily a surprise that activity is slowing. This was always the expectation as the recovery from the pandemic recession of 2020 gradually slowed. But the extent of the slowdown is alarming. Between 2021 and 2022, global growth is expected to experience one of its sharpest decelerations of the last 50 years. Most of the other episodes we have seen, you see on the right chart there, the left chart there, were global recessions. This is especially concerning because global growth is tumbling even though the economic recovery from the pandemic is still far from complete in many countries. Let's explore why everyone has become so pessimistic, starting with commodity prices, moving on to inflation, and then policy tightening. Almost all commodity prices plunged early in the pandemic, but have since risen substantially. These charts show the evolution of energy and food prices, but the rise in commodity prices in the last 18 months or so has been extremely broad-based. 1/4 of the 67 individual commodity prices we monitor were at their highest level in more than half a century at some point this year. That includes European natural gas, wheat, edible oils, fertilizers, copper, tin, but oil is the big one. The increase in nominal oil prices between April 2020 and April 2022 was the largest since the 1970s oil price shocks. The war in Ukraine has, quite deservedly, gotten a lot of attention for its impact on commodity prices, but it's important to note that about 3/4 of the oil price increase over this period had already happened prior to Russia's invasion. Now, many commodity prices have come down recently, especially metals, but many others remain extremely elevated, especially energy prices. High energy prices weigh on the economy in a few ways. First, they reduce consumers' disposable incomes, and second, they worsen fiscal and current account balances in energy importing countries, which is most countries. The massive increase in natural gas prices you see here is expected to help push the euro area into recession later this year, for example. Food prices have also climbed sharply, which is especially painful in poorer regions where food is a large share of the consumption basket. Nearly 200 million people were in acute food insecurity last year, mostly in sub-Saharan Africa, and that number is certain to have gotten higher this year. In the right chart, you can see that food prices have more than doubled in many countries and is up substantially in many others. Food price inflation in South Africa, for example, is running at something like 10% year on year. Higher commodity prices have led to higher inflation. On this chart, you can see that global inflation has risen by 9 percentage points in the last 2 years, from a record low of about 1% in 2020 to about 10% now. As Therese mentioned, this is a 40-year high for advanced economies and a 14-year high globally and in emerging markets. Inflation is running above target in every advanced economy that has such a target, and almost all inflation-targeting emerging markets. Now, commodity prices aren't the only driver of this massive increase, of course. The world also experienced a major increase in demand during this period amid widespread supply bottlenecks that also helped to push prices up. One nice bit of news is that we believe that global inflation either has or is very close to peaking. This figure shows our forecast. We expect that global inflation will gradually decline to about 3% by the end of next year, which may still be too high for some countries, by the way. And a good chunk of this decline is related to the one-off shocks from commodity prices and supply bottlenecks gradually waning. But the most important element is that demand is being brought down through a great deal of policy tightening. These two charts show that the world is currently engaging in the most synchronized and rapid global fiscal and monetary policy tightening on record. Central banks were surprised by the speed of the increase in inflation we've seen and are fearful of losing their very hard-won credibility. This chart shows a simple count of policy rate cuts and increases by central banks around the world. It shows that central banks are unwinding the support they provided during the pandemic and tightening policy at a never-before-seen pace. The blue bars showing the recent increases is basically vertical. The same is true on the fiscal front, shown in the right chart. Governments, quite understandably, provided a great deal of stimulus to shield their people from the economic impact of the pandemic, but that level of support was never going to be sustainable. As it is wound down, which has already started happening to a great extent, it is dragging on growth, just like monetary policy. People and businesses have, of course, noticed that inflation has risen sharply. They've noticed that central banks are doing whatever they can to bring it under control, and they've noticed that global prospects are deteriorating rapidly. As a result, global confidence is plummeting. Here you can see how consumer confidence in major economies and global investor sentiment for expectations have dropped like a stone since the beginning of the year. In addition to the global story I've told of tightening policy, there are also some important country-specific developments affecting these lines. The US has already had 2 quarters of negative growth, even before the impact of policy tightening had truly started to bite. The euro area is experiencing a continent-wide energy shortage, and China has both COVID lockdowns and problems in its very large, very important real estate sector. As a result, confidence in each of these places have fallen to levels not seen since the depths of the global financial crisis of 2009, and it is not clear that they have reached bottom. Let's move on to my last question. What do these global developments mean for emerging markets? These two figures set the stage by showing some very important vulnerabilities that have been growing. Focus on the red line in the left chart. Debt in emerging markets, both public and private, climbed sharply over the last decade, took another jump up during the pandemic, and is now at a record high. Servicing this large stock of debt is becoming increasingly difficult as growth slows, exchange rates depreciate, and interest rates rise. This is especially true for the quarter of government debt that is denominated in foreign currency and the third of external debt that is subject to variable interest rates, as shown on the right chart. Investors see that we are entering a volatile and risky time and are becoming increasingly risk-averse. I'm sure that includes many people in this room. You can see on the left chart that we've seen capital outflows from emerging markets in the last 6 months or so that are roughly equivalent to the taper tantrum of 2013, which was a stressful period, as I'm sure you remember, but not quite a global crisis. At the same time, we've seen substantial currency depreciations, falling stock market valuations, depletion of foreign exchange reserves, rising credit spreads, and a decline in many countries' willingness or ability to borrow in international bond markets. Now, previous periods of monetary tightening, like we are seeing now, have led to widespread financial crises in emerging markets. The Volcker disinflation of the 1980s led to widespread financial crises in emerging markets as interest rates rose, the USD appreciated, and global growth slowed to the point of global recession. A similar chain of events happened in the 1990s. The hope is, this time around, this can be avoided. It may be that central banks are able to get inflation under control quickly. It may be that capital buffers in the financial system are sufficient to absorb the inevitable losses we are seeing. It may be that growth starts to rebound after only a brief rough patch. I certainly hope that's the case. Let me quickly summarize my main points before passing things on to the other panelists. 1, we anticipate an abrupt growth slowdown in growth next year, while inflation is near its peak, but is likely to remain uncomfortably elevated even as it comes down for a while. The slowdown in activity is primarily due to an unprecedented degree of synchronized policy tightening, both monetary and fiscal. 3, emerging markets are in a risky period where elevated debt burdens are becoming more and more difficult to address. My team has a great deal of additional material on these subjects I talked about today at the following locations. Our main report should be easy to remember as it almost shares an acronym with our conference organizers. Our Global Economic Prospects, GEP report, will be published in January. Our Commodity Markets Outlook is out in October. We have a monthly publication that summarizes global economic developments, and we've also produced some recent books that go into much more detail on many subjects, including debt and inflation and other such timely topics. I'd invite you to have a look at any of all of these materials. Thank you very much.
Thank you so much, Patrick, for the tour de force. Like providing such great detail on the economic outlook. Allow me to ask Ezekiel to focus on the specific outlook for Africa and what the impact of rising interest rates, a strengthening dollar, and rising food and energy prices means for Africa specifically. Thank you.
Good morning, everyone, and thank you very much for having me. I'm going to actually be speaking on the challenges for the African continent. Why I hope I was bringing very good news, but we're all facing very unprecedented times. But I'm going to try to sort of give a picture of how we move from looking at the challenges and seeing what the opportunities are. And I think I draw strength as well from the Minister of Finance, who graciously touched on some of those points.
May I ask Sonia to help us understand what Patrick presented and the themes Patrick presented, the challenges Patrick presented are already priced in financial markets. Thank you so much.
Oh, wonderful, some slides. So good morning. It's a pleasure to be here today. I would like to continue with Patrick's theme of the broader outlook for the economy, but like to shift focus a little bit, really to what it means for policy and then also financial markets. So we are now well into the third quarter of this year, and it's been a very challenging year for investors. For sure, the performance across asset classes has been varied, but overall, returns have been negative. The striking exceptions here are commodities that are up more than 20% this year, and of course, the US dollar up 8.5%. But in terms of performance for bonds, we are looking at around 10% negative for US bonds, and between 14 and 19% negative for emerging markets bonds, depending on whether it's local currency bonds or hard currency bonds that at times actually have performed worse. Similarly, you can see there for equities, in developed markets, returns are down, negative, around 14%. And in emerging markets, investors have looked at negative yields of 21%. And you can see in the light blue bars, even a change over the last month. There were further sell-offs, in part due to hawkishness by US policymakers. Now, one way to look at the outlook for next year graphically is to look at a decision tree. And that decision tree, I would argue, could have 3 doors or 3 possible outcomes. The first door really is the one that has been priced in now, or been pricing in into markets through most of this year. It is one where supply shocks induce an upfront, near-term synchronized global recession in the second half of this year. There are a multitude of shocks, but predominantly driven by what Patrick had outlined in terms of higher energy prices and also higher food prices that led to a spike in inflation to levels last seen in the 1970s and 80s. A second alternative door is not an imminent recession, but rather a recession induced by policy measures in 2023 and 4. And then alternatively, the third door, the one that Patrick said he hopes for, is the so-called soft landing. We can look at a variety of measures in terms of what is priced into markets. These can be simple measures that just focus on one metric, such as in gray, in terms of the yield curve. Some binary models in terms of equity and high-grade spreads in blue, or even more comprehensive models here indicated in black. All of these indicate that of relatively low initial levels at the end of 2021 and early 2022, roughly 10% or so recession risks, it has risen to on the order of 50% right now. Now, when it comes to what is actually driving these recession risks, the performance is fairly uneven. As you can see, the weakness is really centered in sentiment indicators such as consumer sentiment and manufacturing sentiment. Those are the couple of red lines in the first 3 rows. In contrast, the labor market overall in developed markets, but particularly in the US, has remained very strong. So recently, confidence has been stabilizing, moving slightly sideways, to even improving, at least as indicated over the last couple of weeks. At the same time, energy inflation outside of Europe is peaking, modestly moving lower, and the US labor market continues to hold up. So to some extent, that risk of the door one, the immediate near-term synchronized global recession risk that had been priced in, is starting to reduce a little bit. It's probably now below 40%. But we call this situation, I would argue, near-term resilience, but not sustainable over the long term. The reason for saying so is that in the absence of a near-term synchronized recession, in the absence, then labor markets probably will not soften substantially in the US and elsewhere. And in turn, the lack of softening in labor market means that the inflation outlook for the US in particular is not substantially improving. We have had the reminder again this week where US inflation surprised to the upside, particularly core inflation. And so this chart just shows you now how much markets are expecting in further tightening from the US of levels of 225 right now to peaking at around 4% by the first half of next year. That's illustrated in the blue line, compared to about a month ago in the gray line, where the peak was seen substantially lower, and then prospects for more substantial cuts already next year. So that amount of further tightening that we've just seen is being priced in from the Fed does overall lead to firmer financial conditions in the US, be that on the short end of the curve, 2 years, long end of the curve, around 10 years, or even floating rate mortgages that you see quite strikingly having spiked in the right chart. And of course, invariably, there is a spillover of tighter US financial conditions to emerging markets. The chart in blue shows you local currency bonds for emerging markets, and the MBIG refers to essentially hard currency debt, dollar debt, by emerging markets. And the cost increase there now is actually at a level that exceeds not only the period during the worst of the COVID recession, but also, of course, the preceding couple of years. Not only have financial markets reacted and there is more expensive debt, and indeed in many cases external debt markets have shut to borrowers, but also policymakers in emerging markets probably will continue to tighten. So I've tried to color code it here for convenience, and in blue I indicate areas where we expect further policy increases. These are on the order of 1 to 1.5% overall globally. And in orange to red are places where we do expect eventual policy rate cuts. These are centered in emerging markets, particularly where there was already a lot of upfront tightening last year and early this year, actually ahead of the Fed, in part because of policy credibility issues. So overall, in short, we expect a synchronized tightening through to the first and second quarter next year. Globally, we're adding around 100 to 150 basis points for here, and in emerging markets, around 100 basis points. The tight issue that Patrick has already alluded to is not only that we now may well be heading to that second door of a policy-induced, also synchronized recession next year, but this is also triggering vulnerabilities in many places in EM and frontier markets in particular already now. And in those places, asset performance can be even more volatile. So we've seen debt levels essentially double from 2008 and 9, and particularly the stock of euro bond debt. This means that not only the amount of debt has been increased, but it's also joined, of course, by the cost of debt having gone up. Consequently, the share of countries where now spreads are above 1,000, so above 10%, is now higher than actually even during the COVID peak or even the 2008 and 9 recession. So the outlook, I think, for emerging markets, I would side with Patrick, is increasingly challenging, although it is quite differentiated. One further differentiation really is in economies that have a need for dollar debt. So joined with higher debt levels and cost of debt, the current accounts have also been under pressure because higher energy prices, of course, mean a higher import bill. So it's particularly in those countries that have a strained external balance of payments, that I would argue are most at risk to be included in those countries with yields above 10% spreads. Now, what does this mean for net financial markets? We posed earlier the questions of this door 1, 2, and 3. And I've tried to reflect in that chart that probably door 1 was already priced into markets. The scenario of a very near-term synchronized recession. So as we lessen those risks, there's perhaps scope for equities to recover somewhat, while the outlook for bond markets remains strained in the face of further tightening by the Fed. Moving into next year, however, it crucially depends whether we're heading for that second door, a policy-induced recession globally, or alternatively, the soft landing. In either scenario, however, what is a bit more clear is the outlook for the US dollar. As we now consider more regional recession dynamics, where the euro area is under pressure and likely enters a recession, as Patrick outlined, is already widely expected, the US may actually relatively outperform, and that tends to be dollar supportive. Similarly, hawkish comments by the Fed, followed through by action, of course, underpins overall dollar strength. The flip side of that is that for emerging markets, the pressure on currencies may well continue into next year. Thank you very much. I'd like to now hand over to Daniela.
Thank you, Sonia, for providing us such a detailed picture on what is priced in and not priced in, and how the regions of the world are affected by the current economic challenges and geopolitical challenges. May I invite Olano to help us understand what this backdrop means, this rather gloomy backdrop means for African pension funds. Thank you.
Thank you so much, Daniela, and good morning, everyone. And it's so good to be back in Cape Town, Daniela. And, I sort of somehow anticipated that Ezekiel might go through some glitches, so I don't have a slideshow. No slideshow. We're just going to have a conversation, and I'm going to touch on a few points. So I'm going to try and bring all of this together, and particularly what it means for retirement funds and members, because ultimately it's about the members, right? And I will try and keep it as simple as possible. So I will touch on interest rates, inflation, which clearly is an issue. Foreign markets, so some of you would know South Africa has just relaxed, its foreign exposure allowance, which has caused some sensation. So I think it will be useful just to touch base on that. Then the economic recovery, and that will touch a bit on COVID-19, just to give you a sense in terms of the impact on retirement funds. And lastly, how I see the new world shaping up, because things have changed. And so, some of you would have witnessed challenges locally, globally, with members trying to access their retirement funds, and whether should we be designing systems which start, looking and managing some of these shocks. So just to start with interest rates, and I'll try and put a positive message to this. There's a lot of doom and gloom out there, so it does help to see some silver linings. So as you would know, the good thing with rising interest rates, and yes, it might sound a little bit counterintuitive, but the good thing with rising interest rates is that your liabilities as a retirement fund come down, right? And that is a big benefit if you are a defined benefit fund. And this is the simple, formula around the present value of future liabilities and interest rates. But it's also positive for defined contribution funds, right? Because then your assets are performing, and so you are able to meet your liabilities, even though they are not in this instance guaranteed. Your money market, rates would be performing quite well. And so there are some positive aspects with rising rates. And this is important on the back of what we saw post the global financial crisis, right? So Europe and America literally had rates hovering around 0%. And if you're a defined benefit, and America has still got quite a lot of defined benefit funds, this would have been a shock, because then essentially it means your liabilities have gone up. Now, the one thing you don't want as a member or a retiree is to reach retirement and be told, you know what, sorry, I'm not so sure I'll be able to pay you what I promised you. That's literally, the worst news you can have. And so there is some silver lining. There is some silver lining on increasing rates. Of course, it is a bit of a double whammy, right? And I want to come to inflation now. So most of us in here, well, or maybe many of us would also have mortgages, bonds. And so you feel the pinch immediately, right? And then you have to deal with inflation. I mean, it's interesting that, a month ago when I, filled my tank for the first time, I really got a shock of my life, right? So I had to fill my tank at around 2,000 rands when I used to pay at least 1,000 a couple of months ago. And this would have to be done at least twice in a month. So you, as an ordinary person, you can really feel the shock. And the one thing we tend to miss is that we don't talk about real interest rates a lot, right? We kind of focus on nominal interest rates until you look at real interest rates, which are nominal interest rates less your inflation, that you see that actually things don't look particularly good, even for you as asset managers and fund managers. And so I was checking the numbers yesterday. South Africa's CPI is sitting at 7.8%. The prime rate is at 9%. And I better get my maths right here, given what people have said earlier. I mean, that's literally a difference of 1.2%. That's the real return. It's 1.2%. And so it does up the game for funds, because then you will need to find ways to get your assets to perform in such a way to provide a more than decent return. And it does, in a way, open up some risk, because then there's a desire to find yield, better yield elsewhere, and then you end up going into the riskier assets, and some things can go wrong there. So one does need to keep an eye in terms of how this is managed going forward. Then on foreign markets, so as I was saying, there was a line hidden, and I can say this because the minister has left. There was a line hidden in the budget review around a higher foreign exchange allowance to 45%. And to be honest, I think there's been a little bit of hysteria around it. So I'm still fielding questions from everyone, politicians, asset managers, etc., because of the anxiety around capital flight. Now, technically speaking, it's only a 5% increase, right? Because we always had 30% and an additional 10% for Africa. And so we've just topped that up to 45%. And I think one needs to appreciate the need for an optimal portfolio here. So not everything that is foreign is exceptionally good, right? And I think Patrick showed that globally, things are not looking particularly good. So it shouldn't follow that because now there's a higher allowance, then it makes sense to rush to go offshore. Yes, there's still a good reason for foreign diversification. And this is something we kind of miss out in South Africa. I mean, our markets literally make 1% of global markets. Literally 1%. You don't have Apple listed on the stock exchange. You don't have Tesla on the stock exchange. You don't have Google, right? And those have been some of the high-performing stocks. And so when this decision was taken, part of it was to enable that foreign diversification. But in doing so, you have to obviously be prudent because the rand is also quite volatile. It is quite volatile. And of course, as you see the US increasing their rates because of flight to what is perceived to be safe haven, it is going to have an impact on the currency. So I think it's important just to appreciate the need for balance and prudent approach when it comes to foreign diversification. coming to economic recovery, so COVID has affected everyone's life. I mean, none of us ever thought we would live through a pandemic with hard lockdowns. I mean, at some point I was saying it does feel apocalyptic, right? I mean, there are droughts, unprecedented droughts in Europe, wildfires, in America. And so things don't look particularly good out there. So COVID has shocked, some of our retirement funds. So we ran a survey and it showed that nearly 47% of our retirement funds were under some distress. And by that I mean the employer and the employee had approached the retirement fund asking for contribution holidays. It doesn't have that much of a negative bad effect on retirement funds, and the Actuarial Society has done some numbers on this. So the funds are still pretty much sound, and because of the strong recovery post 2020. And by the way, I mean, if you look at the historical chart on stock exchanges, 2020 was actually worse than 2008 in terms of the slump. It was literally worse than the global financial crisis. So it gives you a picture of how bad, COVID was. And so it started raising issues around how do we get the economy to recover. Globally, by the way, it was not only a South African issue. And so infrastructure has been identified as probably the one lever that can assist economies to really kickstart. And I'm glad what the minister said earlier. Actually, I nearly had a bit of a heart attack when he mentioned prescribed assets. But I think we are now on the same page with the minister. So I think we can now officially say prescribed assets are off the table, right? And rightly so, And so what we have done is for the first time to signal to the industry, to trustees, that actually infrastructure is a good asset, or can be a good asset, right? And so we have enabled more investments into infrastructure by, as I was saying, for the first time, including a new asset class in Regulation 28. So for those of you who might not be familiar, Reg 28 is simply your asset spreading requirement instrument. So for the first time, we have explicitly allowed for exposure in infrastructure up to 45%. We have even gone further in the definition by allowing the private sector to also play a role. So the first draft, some of you would recall, focused only on public infrastructure. And as the minister said, there is no way the public can be able to do the funding alone here. So we have been doing some work on the policy and regulator side. Then it's private equity. And again, with the new Reg 28, we have increased the limit to 15% from 10%. Part of it is because my sense is that the unlisted space is going to become quite important in the near future. Stock exchanges are experiencing delistings, including the South African one. And so the unlisted space, I think it's a space to watch. Yes, there might be issues around opaqueness, transparency, etc. But I think as a regulator, there's always a way to manage those issues. We can obviously come up with reasonable regulations. So we shouldn't regulate the industry out of business, which is quite important. But more so on the real economy. So there is an argument that yes, as much as your listed stocks provide you with the transparency, they provide for liquidity and deep financial markets, the money doesn't always end up in the real economy, right? And so there is a sense that one needs to leverage or see how best to leverage the unlisted space. And by the way, private equity has done quite a lot of work and good work on renewable energy. And so we were pretty much comfortable, enabling a higher limit there. I'm watching the clock, Danielle. Even though I'm a regulator, I can talk forever, but I think I need to remind myself. Yes, I've got 2 more minutes here. So the last item is on the New World Order. So Africa has got a young population. Africa has got a young population. 85% of Africa's economy is literally in the informal space. And it's something people miss. So even when you look at countries like Kenya, like Sierra Leone, Nigeria, you'd be surprised that on average around 80% of their workers are employed in the informal economy. And that raises quite some important questions. Is the current retirement system delivering to people it should be delivering to, right? Because the current system works on someone being full-time employed, earning a regular income, being able to contribute regularly. And so one does need to start thinking quite differently about how best to provide for the youth. And that's why I think the two-pot system which has been proposed by the Treasury is actually quite a good system to think about. Because, you know, the youth find it very difficult to think about retirement. As much as, you know, they should, it's not an easy concept. And I was saying, you know, joking at one of the conferences that, you know, for the youth, it's more about saving for your first car, your first house, your first wedding. I mean, even though that should be your only wedding, but, you know, these things do happen in life. So you kind of need to design products which will work for the demographics, for the people in the country. And so to conclude on that, I think as South Africa, we are on the right track, and some of the major economies are actually looking at enabling some kind of access, early retirement access. Sorry, not early retirement, early access to their retirement benefits. Let me stop there. Thank you so much. Thank you, Daniela.
Thank you. And of course, this really detailed picture and ending on a more positive note in this gloomy world. Before we get the presentation ready for Ezekiel, may I really encourage all of you, we have an expert panel, I think they've proven themselves. Do get your questions ready. We do still have time for the question and answer period. So Ezekiel, shall we try again to present your view on the economic picture on Africa? Thank you.
Thank you very much. Yeah, thank you so much, Danielle. I hope, okay, it's up. So thank you so much, and thanks for your patience and going through this technical glitch. Sometimes technology doesn't quite solve everything. But I'm going to sort of paint a picture of the African context. Obviously, we are facing quite some challenges, but I'm actually going to really bring out some of the opportunities, because I think when you have unprecedented challenges, obviously it's just tell about unprecedented opportunities. So I would actually follow those lines and also talk a bit about some of the issues that are peculiar, particularly to the continent, which we don't often talk about, but it's also coming across as one of the big challenges, which is climate change. As you can see on that slide, we're all feeling the pinch. And I think without being so gloomy, I would also just sort of touch on what the outlook has been for the continent. So Africa actually recovered quite well in 2021, particularly obviously driven by global demand that came back, and as well as the lockdowns that were eased. But we are getting back to a situation where we are decelerating very, very fast. And this is not just peculiar to the continent, but also to the global economy. And majorly, what's driving that is obviously the Russia and Ukraine crisis. But beyond that is also the fact that COVID hasn't quite left, so I think we should also put that on the burner. And the issues about climate change, which is something I will touch on in terms of some of the risk peculiar really facing the continent, even though it's global. So just to dissect what this growth has been, I mean, looking at the regions, you can see very clearly that North Africa really recovered, but decelerating very, very fast. And I think if we zero down to the southern part of the continent, there was a very big recovery from the contraction during the COVID pandemic, but we are decelerating somewhere to about 2.5%. And if you sort of look at groupings of countries, depending on whether they are oil producing or commodities driven, I think as the minister quite said, it depends on which group you're in. You actually may be benefiting from what's going on currently with the high commodity prices. So countries like Nigeria, South Africa, that are very also commodities-driven economies have actually benefited from high prices. But there's also been some challenges in those regards, particularly Nigeria, for example, the issues about oil theft, but South Africa, obviously, with the flood and few climate change shocks. So if you look at that story, it does give you a picture that the macroeconomic fundamentals have improved. But beyond that, I think we actually face quite uncertain challenges in regards to that could really go south and go south very quickly. So if you look at some of the parameters to gauge that, you can see that debt to GDP is improving, current deficits as well. But when you contrast that to what is going on at the moment, you can clearly see that that can easily change. So it's quite uncertain because countries are grappling with the inflation and central banks are tightening. There's high oil prices and energy prices and food prices. So governments are having to do quite a bit more. And but to really stress, I think it does call for some of the rethinking in terms of what should government really be focusing on. And I think given the Russia-Ukraine crisis that has really sort of pushed these challenges to the brink, we are now seeing some debt vulnerabilities across the continent. So if you look at that, it's not quite a very good picture to look at, to see that about 19 countries are actually back to the IMF, whether trying to renegotiate a package, or rather 23 countries, and I think 3 countries there are also on track in having a negotiation with the IMF. So it does tell us that there's need for structural transformation, but also looking at in terms of how we sort of balance the fiscal and the monetary policies, rethinking of what priorities for government should be. Government shouldn't necessarily be investing in areas that private sector can be brought in, and sort of pro-growth policies that can help sort of drive and attract private sector investment. And I'm very glad about what the Honorable Minister said this morning in terms of how do you sort of unlock this private capital, because there's just no way that governments can actually, or the fiscal policies can actually address this through public finance. So we also have these inflationary pressures. It's good to actually mention that some of these are really the near-term challenges that we face. We can see high rises in interest rates, particularly across the continent, but even more so in terms of inflation. And some of these challenges are also exogenous. They're exogenous to the continent. Many of them, obviously, with what's going on with the developed economies. And when you actually tighten those sort of monetary conditions, obviously the other countries and central banks follow. So we've seen these really fueling sharp rises in commodity prices, particularly food and energy. But also the Russian and the Ukraine crisis haven't quite helped in that regard. So this is where the opportunity really comes. And I would sort of zero down briefly to the climate change question. Just for the recovery alone, in terms of the pandemic, we actually need about 432 billion between 2020 to 2022, just for the recovery. But how do we actually recover? I think that's a good question. We can obviously depend solely on the carbon-driven economies anymore, but seeing how we actually begin to look at climate resilient and development and pathways in terms of how do we leverage renewable energy, but also how do we look at what is facing the continents at the moment, even globally as well, in terms of climate change risk. So climate change is a very, very big risk for the continent. And I think last year or early this year, we saw what happened even in South Africa. So when you look at this very carefully, you see that in terms of vulnerability, Africa is most vulnerable to climate change. But also in terms of readiness, we're the least ready continent in terms of climate change. So it really begs to question how can we actually get out of this without more investment in this area and actually create more jobs as well. But there's a big question in the room, and that question is how do we actually transition? Because if you look at the data, Africa only contributes about 3 or even less than 3% of global emissions, of CO2 emissions. And when you compare that to other parts of the world, the US, for example, even looking at per capita, Africa contributes just 0.9 tons per capita in terms of climate change or CO2 emissions. But if you look at for the US, for example, that's about 14 tons per capita. So the question is, how do we actually address this transition? It just can't be that the burdens are the same, and that's why we're calling really for a just transition, looking particularly at gas and having that sort of headroom where countries can transition in a very managed manner. But this raises also an issue in terms of how we define the next phase of our development going forward. We cannot rely anymore on the things that we used to do before. We need to build more resilient infrastructure. We need to make sure that our investments are more climate resilient, and it's also good for the environment as well. So these are real impacts when we talk about the socioeconomic impact of climate change. I can tell you very clearly that even on a per capita basis, the continent loses between 5 to 15% of GDP just by climate change alone. And that is even when you look at the southern region itself, is about 10% being lost GDP to climate change per capita. So these are not small things. These are really, just pause for a minute and think about that. I mean, think about what happened in KZN and on other parts of the continent. So climate change is not just a question of installing technologies, but it's resulting in conflicts, is resulting in migration, is resulting as well in mortality. So we really have to take a hard look as to how we build into the future in a more resilient manner. And I think the Honorable Minister made it so clearly. I think it's not a very good time to be a Minister of Finance, to be honest, because the issues are just too many. But this is what the scale of the climate finance gap is. And I raise this up because I think when we talk about how and where to invest, these are some of the new opportunities that we think are very important for institutional investors and even government to begin to look at. So when you look at between 2020 to 2030, what is actually required, we need close to about 4.5 billion investments in climate change, looking at a gap of about 1.2 trillion, sorry. And what that tells you is that if we continue at the current rate, we're never going to actually be able to meet the expectations. So I end with just saying that it comes down to investment. And I think this is a good part because when you look at the institutional capital pool, the asset under management for institutional investors in the continent. That's about $1.8 trillion. And we look at as well, I mean, even on the South African sense, or rather even on the pension fund, I'm glad I'm speaking pretty much to the largest pension fund in the continent. You have under your asset under management about 1.6 trillion rands. So it really begs to see how can we crowd or attract this capital to address some of the challenges that I've just mentioned. The macroeconomic landscape is improving, as we said. There's a huge gap in infrastructure. There's also the gap in funding the recovery, as well as in terms of the gap for climate resilient investment going forward. And let's not forget about the trade, because trade is a very important component when it comes to jobs, and also when it comes to actually the continental free trade, which is the largest in the continent. That's going to require quite a lot of investment. And this is a $3.4 trillion size market. So there is opportunities despite the challenges. And if you ask a lot of the market operators, the best time to invest is the time where everybody is crying a bit wolf. So I would just invite you to begin to look at how we address the pathway going forward, but also how we do that in a very responsible manner, and where the capital is going to come from. The capital is not going to come from the public sector, it's going to come from the private sector, and institutional investors are a key part of that. But also the development banks also working very closely with institutional investors. I think a lot can be done. I know institutional investors grapple a lot with how you actually can do the due diligence of these investments. But this is where the MDB is coming, because then we can help some of this investment in a very clever way, and then allow sort of this capital to be unleashed. And I'm glad that I have the NSSF CEO here with us today. I mean, we had a conversation on the Kampala Ginger project some time ago in saying how we crowd in the NSSF into that infrastructure. So it's possible, but we just have to be bold, and we just have to weather the storm. So thank you very much, and sorry again for the glitch. Thank you.
So, thank you, Ezekiel, and for this picture on the challenges, but as you said, also the opportunities that the current environment presents for Africa. I do think we have we have time for questions before we release you to a well-deserved coffee break. If I may encourage anyone who has a question to go to the microphone, introduce themselves and their affiliation, and ask the question. Anyone? I think we have a question coming up. Thank you, sir. Please go ahead.
Hi,
Please go ahead to the other while we wait. Thank you.
Hi, good morning, everyone. Stuart Haynes from the St. Vincent National Insurance Fund. So there's some key issues being discussed, but I want to look at more the pension funds. And we mentioned about the relevance to the informal sector, which is growing. What I would like to know is, and key to that, is coverage and also job creation. What I would like to know is sort of what are the policy directions around in terms of job creation, also in stimulating the private sector by way of the cost and ease of doing business, so that alone will lead to job creation, and how the policy by the pension fund around capturing in terms of the growing sort of employment. So those are the two questions. One, the relevance of the pension fund to the informal sector, right? And secondly, around the policy direction around cost and the ease of doing business in the continent so that to create more jobs. Thank you.
Thank you so much. Olano, may I ask you to take this question, and if other panelists will tell me by raising their hands whether they want to chip in after.
Give it a bash. So thank you so much, Stuart. Look, it is quite a tricky question, particularly the second part. I mean, it would ideally be best responded to by government, but I think I can touch on it. So on coverage, as I was saying, there is that reality in Africa that our economies are still pretty much on the informal side. What other countries have done very well is to roll out what is called micro pensions. So Rwanda and Kenya have been quite successful in enabling a system which has got flexibility. And the key is flexibility there. Well, flexibility and also incentives, right? Because it's very difficult to compel that cohort to contribute into a retirement fund and do it consistently because of the irregularity of income, right? The irregularity of employment. So what has worked pretty well in those countries is literally a matching contribution from government. And this is where it gets a bit tricky for South Africa because until I think Treasury is comfortable with its financial position, it might be a little bit tricky, doing a matching contribution. And two, flexibility. So you need to have a platform which can enable informal workers to easily save. And usually they've used the mobile cell phone platforms, Mbao and M-Pesa. Part of dealing with the coverage issue, it's just something that Treasury is thinking about, is auto-enrollment, right? But that works well in the formal sector. And it's been very successful in the UK. On the economy, look, I mean, the president has indicated and publicly that he is aware there are these red tapes in the system. He has appointed a team to look into those. And I think, these things take time. Unfortunately, we don't have all the time in the world, but they do take time. And so I think with time, it will start bearing some results. As the regulator, we try and be proportional in terms of how we regulate the industry. And so without compromising, the protection of investors and members, we do try and find ways to enable new entrants, into the financial sector, and there are ways of doing that. I hope that answers to some extent the question.
Absolutely.
Sure.
Thank you so much, Orlando. I do not see a raised hand, so may I ask the gentleman to ask his question, please? If you could kindly introduce yourself and name your affiliation.
Thank you.
May I ask you to step to the microphone?
Sorry.
We're all showing growth resilience today.
Good morning or good afternoon from Cape Town. My name is Kabelo Moja, and I manage a private equity fund. It's called Ascension Capital Partners. I wanted to pose the question to Mr. Makubela, just in respect of Regulation 28. So it's a fantastic regulation. We all want to ensure that you allocate risk across a fund or portfolio. But I wanted to, practically on the ground, you've got this initiative, you've de-linked private equity, you've given it its own 15% allocation. Are you seeing any trends in terms of, what are the initiatives to actually encourage pension funds to invest into private equity funds themselves? That's the first point. I think the second point was just in respect of the infrastructure allocation. So you have this 45% allocation into infrastructure. And I think the big question, or the burning question, is, what sort of infrastructure does it cover? Does it speak to direct investments, or, for example, listed bonds that invest into infrastructure? And then I think the third point just relates to the 10% allocation into the rest of the continent. And, what are your thoughts around that? What does that actually entail practically? Thank you. Thank you.
Well, thank you so much, Olana. You're in high demand. Please, go ahead.
So thank you so much, Kam. Let me start with the 10% one. When we designed that system, and then I was still at the National Treasury, part of it was to enable South Africa to be the gateway into Africa, right? The sad reality is that the industry has literally not taken up that 10%. And so let's have a frank discussion here. The industry hasn't taken up that 10%. Now, there are various reasons, and some are valid. One being that, in Africa, you struggle to find large, deep, listed markets, right? I mean, I sit at IOPS, International Organization of Pension Supervisors, with other African supervisors, and they do acknowledge that challenge, that, they don't have as large and sophisticated, listed markets like South Africa. But one can still find a way to invest in Africa. I mean, when we check the numbers, the last time it was hovering around, 2 to 3%. And so the thinking was that if there isn't that take up and it probably complicates the allowance, let's just bundle it into one simple allowance, which is 45%. And the industry can decide how best to allocate, those investments. But yes, I must say, it's been disappointing that South Africa hasn't really taken up, that 10%. On private equity, again, if you look at the return from private equity, probably in the last 10, 15 years, they've actually performed better than the JSE, right? Net of fees, by the way, net of fees. Yet, again, the take-up is quite low there. So when we went through our numbers, I think on average it was around 2.5 to 3%. And I suppose it goes to the issue around trustees and how comfortable are they with the alternative investment class. And I was saying, in one of the conferences, that it's so ironic that investors and trustees are comfortable losing money in a listed stock vis-a-vis in infrastructure or private equity, right? There's that irony about it. And so look, you kind of need to keep educating the trustees. And I think as they see that, private equity and private debt are actually viable instruments. In fact, in Kigali 2 weeks ago, there was someone who made a very interesting comment that Africa has got the second lowest default rate when it comes to private debt. Second lowest in the world. And yet people are still averse towards investing in private. So part of it is just the mind shift and education. On infrastructure, look, it is currently mainly direct, but we will clarify that. We will issue, reporting guidelines. Yeah, I know I'm not giving you a perfect answer, but wait until you see the reporting requirements, and they will be draft, so you will be able to comment. But currently, it's more direct.
Well,
thank you.
Thank you so much. I think I should allow you to continue the discussion over a well-deserved conflict. Can you please applaud share me in thanking the panel participants for their provoking presentation. Thank you.